You ever see this happen? A company drops some great profit numbers, but then its stock price tanks. It's a classic head-scratcher for investors. Well, that's exactly what we're digging into today with advanced enzyme technologies. We're going to find out what's really going on behind the numbers.
So, check this out. On one side, you've got a really nice 13% jump in their quarterly net profit. I mean, that sounds fantastic, right? But then, you look at the stock and it's down 15% over the last 6 months. The market is clearly not impressed. So the big question is, what are investors seeing that isn't in those shiny headline numbers? Let's figure this out.
Okay, so first, let's look at the good news, the stuff on the surface. When Advanced Enzyme put out their results for the quarter that ended in December 2025, everything looked, pretty solid at first glance.
Right, the big headline grabber was this, a nearly 13% increase in their net profit compared to the same time last year. We're talking about a jump to 42.5 crore rupees, up from about 37.5 crore. And hey, for any company, double-digit growth like that, that's usually party time.
And it wasn't just the profit, either. Their sales also edged up a bit, by about 1.7%, coming in at almost 172 crore rupees. So you've got sales going up, profits going up even faster. I mean, on paper, this looks like a company that's absolutely crushing it. Everything's pointing up.
And that, of course, brings us right back to that big question. If the final number, the bottom line, looks so good, why are investors so, unconvinced? Why aren't they buying in? The answer isn't in that final profit number. Nope, it's buried a little deeper in the nitty-gritty details of how they operate.
All right, this is where we find that hidden detail. Because look, in business, it's not always about how much money you make. It's about how efficiently you make it. So let's peel back a layer here and take a look at the company's core profitability.
The magic number we need to focus on is something called the operating profit margin, or OPM for short. Now just think of it this way. For every single rupee they make from sales, how much of that is actual profit from their main business, before they pay taxes and interest and all that? The higher that OPM, the more efficient and healthy the business really is.
And bam, right here, the whole story just clicks into place. Look at this table. At the very top, you see sales are up a little. Okay. At the very bottom, that net profit is up that nice 13%. Great. But look at what's going on in the middle. The operating profit margin, it took a nosedive. And because of that, their profit before tax is actually down 11%. This is the little detail that's got investors worried.
You can see that squeeze plain as day right here. Just last year, their operating margin was a really solid 32.7%. This year, it's dropped all the way to 28.7%. So what does that mean? It means even though their sales are up, their actual business is getting less profitable for every single rupee that comes in the door.
So why would this happen? Well, it usually boils down to one of two things, or maybe a bit of both. Either their costs are going up, the price of materials, running the factories, that kind of stuff, or they're in a tough fight with competitors, which is forcing them to cut prices. Either way, it squeezes those profits.
Okay, so the company sees this problem, this pressure on their profits. What's their move? Well, this is where the story takes a really interesting turn. It goes from being about a problem to being about a really big long-term solution. They're making a huge bet on wind power. The board of directors just gave the go-ahead for a massive new project. They're going to develop what's called a group captive wind power plant. Now, this isn't just some small side project. No, this is a major, fundamental shift in how they think about their energy. So, how does something like this even work? Well, the company is going to invest in something called a special purpose vehicle, or an SPV. You can just think of it as a brand new, separate little company that's being set up just for this wind project. Advanced Enzyme will own a big chunk of it, up to 26%, and by doing that, they become a captive user. That's just a fancy way of saying they get to use the power that's generated, which hopefully means cheaper, more stable energy costs down the road. It's also a pretty big change of plans because they're actually scrapping an old solar project to do this instead. And the company's being super clear about why they're doing this. It's all about achieving long-term cost efficiencies. Basically, by making their own power, they're trying to shield themselves from crazy energy price swings, which is a huge cost for them, and hopefully build a more profitable business for the long haul. All right, let's zoom out and put all the pieces of this puzzle together. We've got the good-looking headline number, the worrying detail hidden underneath, and now this big strategic move. So what does it all add up to if you're an investor looking at this company?
First off, you got to remember who they're up against.
Advanced Enzyme might be the biggest player in India, but they are definitely not alone in this space. They've got tough competition from other Indian companies like Concord Biotech and Biocon, and then you have the absolute giants, the huge multinational players like Novozymes and DSM. That intense pressure from competitors, it's almost certainly a big part of why their profit margins are getting squeezed.
So, let's boil this all down. What are the key things to remember? Number 1, the good news. Their net profit is still growing, which is great. Number 2, the big worry, that shrinking operating margin. That's the number everyone's going to have their eyes on. Number 3, their game plan. This big move into wind power is their long-term play to get costs under control. And finally, number 4, the battlefield. They're doing all of this while fighting in a super competitive market.
And all of that leaves us with one big critical question. The company is clearly playing the long game here, right? They're investing in green energy to control costs and build a stronger company for the future. But we all know the market can be impatient. It wants results now. So is a smart, long-term strategy like this enough to calm today's fears about profitability and win back those skeptical investors? Well, that's the real story we'll all be watching.